and Stubbs very shortly to answer any of your questions. So today's kind of broad outline is I'll give you a little bit of a presentation, and if you have any questions, please pop it into the questions either in Zoom, if you're on Zoom, or put it in the comments in YouTube, and my colleagues will send them over to my way. There's been a lot going on in the last little while. I've been traveling around the country and I've been hearing very different takes on what's happening in the economy. Amongst businesses, there's been a sort of sense of renewed weakness. Amongst consumers, I'm feeling quite a lot of angst from rising cost of living and lots of uncertainty. So let me start my presentation and I'll take you through those broad views, and please put in your questions at the bottom and we'll take it from there. All right. So I just need to start with a disclaimer. As you know, we are a regulated entity, and the material that we're going to talk about today is general in nature. It's not necessarily suitable for your particular financial situation, and it's not financial advice. So if you do need it, please get in touch and we can put you in touch with somebody, or there are some great resources available on the Sorted website to find a financial advisor. You guys already know about Simplicity because you're members. This is my kind of stock slide just to kind of explain what we do at Simplicity. Sam will hopefully talk a little bit later about the reduction in KiwiSaver fees, but also I wanted to remind you that for a lot of you, you're not only investing in KiwiSaver, you're also investing in our investment funds, which is roughly about half of our funds under management. And for those direct investments, like our global fund has very, very low fees. So you are able to access different ways of saving that is suitable for you. Our approach is to try and be fairly hands-off and be ethical by doing some screening. As you know, we've been doing quite a lot of build to rent, although it still remains a relatively small part of our portfolio. We're also doing affordable mortgages, and we give some of our fees to social purposes. I'll dig right into the kind of the economic settings because there's been just so much noise, and every day when I wake up in the morning, I go through the Financial Times to catch up on the headlines, and it feels like it's really topsy-turvy. It's up one day, it's down one day. But if you kind of take a little bit of a step back, what it looks like is markets are holding up despite a lot of uncertainty. Whether it's the uncertainty in terms of the state of the economy or state of politics, it's surprisingly holding up really, really well. But what has been really fascinating over the course of the last 12 months that I've been at Simplicity is just how much the nature of risk that we are facing as investors has shifted. Obviously, there was always that economic risk, but we're seeing quite a lot of risk around things like independence of central banks. Are they still truly independent, whether it's in the US or even in New Zealand? We're seeing quite a lot of uncertainty on the economic cycle. In the early part of this year, it looked really good that the New Zealand economy was recovering. But in the last few months, it feels like some of that momentum has slowed. I'll show you some charts to kind of show you that. And given this heightened uncertainty, essentially us living in fat tails, it's really important that we focus on what we can control. So I'll talk a little bit about the economic backdrop, so you just have a bit of a sense in terms of where things are and what markets are doing. First up, I guess, just what's happening in financial markets. On the left-hand side just shows you, hey, Sam.
Oh, sorry, Shamubeel.
You're here?
Here I am. 4 minutes late. That's naughty of me. All right.
Oh, good.
Drop on.
We're just talking about the financial markets. And if you look at the picture on the left-hand side, that just shows you what's going on in terms of the key markets that are kind of benchmarks. So you can see what's going on in terms of the FTSE World in the orange line. It's come back a little bit just in the last few days, but overall, it's really increased a lot from Liberation Day, which happened in early April. And you can see that markets have actually recovered most of it. But if you look on the right-hand side, which is the 10-year government bond yields, in green is the US and in gray is New Zealand. What is really surprising is how much interest rates have increased, but more so for the US than it has for New Zealand. That spread between the US and New Zealand has shrunk, essentially telling us that New Zealand's country risk is now pretty much the same as the country risk of the US, which is an extraordinary thing to say, right?
Next to you.
And
What do you think?
so there's a bunch of other fears that we can see coming through. One of them is around global uncertainty.
I think we just need to put it in their calendars. I think you and I have talked about this. I don't know what.
And you can see that when it comes to oil prices on the left-hand side, they've come off. That's really reflecting, one, uncertainty in the global recovery, but also that there is a whole bunch of production that's going on because there's a lot of pressure amongst some countries like Saudi Arabia that's really struggling to kind of look after its economy. On the right-hand side, you can see what's going on in gold prices. I really like looking at gold prices, not because I like buying gold, but because it's a really good measure of fear. When people are fearful, people buy a lot of gold because it's seen as one of those hedges against uncertainty. And yesterday at market close was the first time it really went over $3,500 an ounce. Extraordinary, just extraordinary. But despite all the kind of uncertainties, what's been really fascinating is just the real economy, surprisingly, is holding up really well. So on the left-hand side is a picture of the growth in global container trade. And what you can see is that, yes, it has moderated, but despite the tariff war and all those kinds of things, it hasn't absolutely plummeted or fallen apart like it had done during the GFC. You can see that in the chart on the left-hand side around 2008, 2009, or what happened during the COVID era. So we are still holding up at a pretty good level. But if you look at the right-hand side, you can see that the malaise that we're feeling in terms of the vibes of the community, that pessimism that we seem to be seeing, that's just as present in New Zealand as it is in our major markets. So in that dark green line is just showing you the consumer confidence of our top 10 tourist markets, just to give you a bit of a sense of how others are feeling. They're feeling a little bit more optimistic than us, but not that much more. Although you'll see in the picture, which I'll touch on again, is New Zealand's taken a bit of a turn for the worse in the last couple of months. Part of the reason why I think economies have been holding up okay is because the big inflation shock has moderated but not disappeared. So you can see that picture on the left-hand side, that big shock of inflation in 21, 22, 23. The current level of inflation is moderate, but it's not low. And that's why what we have seen is this: when you go to the supermarket, the cost of food is still up, cost of insurance is up, cost of rates is up. So it's not like inflation has completely disappeared. So people are still feeling that kind of grind, but the rate of growth is less horrific than it was in those years. The benefit that we're seeing, of course, is on the right-hand side. As inflation has come down, those interest rates that were super high have eased off a lot. Arguably, interest rates in New Zealand haven't come back fast enough or deep enough. As a result, our recession is as deep and as long as it is. So our recession at the moment is arguably the deepest and longest recession that we've seen since pretty much the reforms of the 1980s. So this is pretty extreme stuff. This is the picture that I promised you before. On the left-hand side is just what's going on in consumer confidence. It's in the green line. People are saying that my current finances are worse than they were last year. What's surprising to me is that it's taken a turn for the worse in the last couple of months, because we were starting to see that recovery, that wages are increasing faster than the cost of living. I had expected that we would see that improvement. But of course, with job losses, reduction in hours worked, we are still seeing a lot of pressure amongst consumers. But it's not just consumers. You can see the same is happening with businesses. That green line on the right-hand side is businesses saying that sales in my business at the moment is slowing. Still growing, but at a slower rate. And that was, again, a surprise, because we had hoped at the beginning of the year that this recovery that's coming through will be sustained and will turn into a full-blown recovery by the end of this year. So it feels like every 12 months we say, the recovery is not quite here yet, but we can see some encouraging signs that it's around the corner. And this topsy-turvy nature of the economy, I think I can see in both the domestic economy and the external economy. So in the domestic side, you can see on the left-hand side what's going on in terms of retail spending per person. And you can see that it's been we had a kind of false start of a recovery. It slowed again, and it's kind of bumbling along the bottom. On the right-hand side, what you can see is what's happening with house sales. It fell very sharply after that. The euphoria of free interest rates went up. It fell as interest rates started to come down. We saw the house sales recover, but it's still not sustained. It still feels quite fragile. The current level of sales is more typical rather than strong, if that makes sense. When it comes to what I'm really looking for in the local economy is, are we going to see a recovery in jobs? That's the one that kind of really tends to supercharge a recovery. When businesses are optimistic, when they're hiring, households will also be optimistic and start to do things. You can see that things are maybe stabilizing. On the left-hand side is the number of jobs, and you can see it's ticked up just a little bit, but not a lot. You can see on the right-hand side the number of job ads, still exceptionally low compared to recent history. So we're still waiting for that impasse of the recession to turn. On the external side, the two big things we look at is tourism, because that's our big exports of services, and on the exports of goods, which is mainly meat, dairy, and forestry. So on the left-hand side, you can see tourism had rebounded from the very low levels of the pandemic, but in the last few months, that momentum has eased. On the right-hand side, you can see that we had seen a really good, strong rebound in goods exports. We've seen very good prices for our rural commodities, but just in the last few months, even that has eased off just a little bit. So it still feels very uneven and patchy in terms of this recovery. The other thing that's kind of pulled back a lot of this momentum of the recovery is, of course, immigration was very, very strong. It's not necessarily a good source of economic growth, but when you've got population growth, you get economic growth. What I mean by that is when we had that very strong population growth, we didn't see any growth in GDP per capita. So it's not like our incomes, national prosperity was increasing, we just had more of us. But you can see that has really slowed down, and as a result, that momentum we had is no longer there. Just yesterday, you might have heard news that the foreign buyer ban for property is going to be taken away. There's a lot of angst about this stuff, but my kind of view is that when the ban came in, we didn't see a big drop-off in house sales or prices. And the new policy that's going to reduce some of those pressures are only for properties which are over $5 million. It's a very small part of the market. They make up about 0.2% of sales by volume and about 1.5% of sales by value. So yes, it will create some tension in the very top end of the market, but I think for most of us, it's not going to make a huge amount of a difference. The other risk that I'm seeing both here and abroad is, I guess, political risk. There are lots of different surveys of political polls, but I keep an eye on it because the government is a fairly large part of the economy. Through its OPEX and CAPEX and policy decisions, it is quite an influential part of the economy. And what we have seen over the course of the last few months is there is a very tight balance between the left and right-leaning parties. So it feels like we don't know whether this government will be sustained, and if not, what kind of changes will take place in policies and politics in the coming days, coming months. And on the right-hand side, you can see that, generally speaking, New Zealanders don't feel like things are heading in the right direction for the country, and quite often we blame our politicians for it, rightly or wrongly. So the reason I wanted to kind of show you this is because when there's a lot of pressure on politicians, it creates this kind of pressure cooker environment where there is a need to create announcements, there is a need to kind of show that they're doing something, and it's not always obvious to me that it's necessarily a good thing for us because it's not necessarily good policy that comes through. So just going back to where we started, despite all this uncertainty that I'm seeing out there, what's been really surprising to me has been that equity markets just holding up so well despite all of that. Although, as I showed you, what's happening in bond markets is that those price pressures, those risk pressures are coming through. And at the moment, that country risk premium for New Zealand is much the same as for the US, which is an extraordinary situation to be in. I think that some of the risks that we're seeing around the world is not just from traditional sources of economic risk and financial risk. There's a lot of political risk as well now. For the New Zealand economy, the recovery which had been taking place seems to have stalled. So, it does feel like it's going to be a tough few months, and it's happening in the middle of winter, which makes it really difficult. Hopefully, what we can do with conversations like today is to give you a little bit of awareness of what's going on, a little bit of understanding, and then we can hopefully give you a little bit of focus around what you can control, which is really around what can we do in terms of your investment decisions. I'm not going to give you financial advice, but what I can tell you is what I do and what I focus on for me and my kids is the two usual things: habit of regular savings and letting the power of compounding work in your favor. All my teaching, all my learning and history doesn't give me any kind of edge in terms of being able to predict where markets are going to go. So that's my sort of prepared remarks. I think, Sam,
Thanks, Shamubeel.
you might have some things
well,
that you want to update our members with.
Yeah, well, sorry for being a bit late. When the kiddie crisis gets on the phone, then you got to sort it out, but all sorted out. So, just want to give you an update on the business. It's going obviously very well. We're over $9 billion in FUM right now, and our member numbers are growing really, really steadily. In fact, they've increased quite markedly. I think also we made some pretty significant announcements. The first was our 7th fee cut in 7 years. So that's what happens when you have a non-profit owned by a charity running it. We pass on the benefits of scale to members. So that was very satisfying. And that came in 2 days ago. So it was the 1st of September. So that's cool. The other thing is in Simplicity Living, we had a big announcement of a property purchase in Queenstown. So that will be for up to 600 homes. And that'll be for the workers in Queenstown, basically people who are living there and working there. So it'll be long-term rentals, just like we do everywhere else in the country. That's significant also because it's our first development outside of Queenstown. We have 3 completed here in Auckland. We have another 3 under build, and we'll have 4 in build by the end of the year. It's just a nice sort of segue into a question that pops up a little bit, Shamubeel, about Simplicity Living and how significant it is in the whole, Simplicity business. If you think about it, it's a very high-profile thing. Kiwis love talking about property, right? And we love talking about it too. But in terms of the amount of money invested, it's actually a relatively modest amount. So some of our funds have no allocation to property, and the biggest would be the high growth fund, which is up to 10%. So the other 90% will be invested in other things. And even then, we haven't invested that 10%. That's our benchmark allocation. So we're building up to that over the years. So it's a high-profile thing, and of course, if you're in Auckland and you drive past these things, they're huge. You see them, but it's only one part of our business. It's a fun part of the business, exciting. The return profiles we think look very good for members as well, so it's a great investment as well.
And of course, the returns that are made by the property development is enjoyed by the members.
Absolutely.
So there's no leakage.
Yeah, so Simplicity Living is 100% owned by the funds that invest in it, so all of the benefits go back to members here.
Yeah, and I think the other thing that I want to reiterate is not everybody who invests in Simplicity invests specifically through, those funds. So quite often they'll have direct allocations into global equities or global bonds. And those are also good ways for you to find the right balance in terms of what you might want to have in your portfolio.
There was a question from Kevin too that came and it said, my question is prompted by the amount of new builds activity Simplicity Living is involved in. Should New Zealand property and or society more widely go into serious financial decline, what are the risks to my investments in your KiwiSaver funds? What protection to my investments will Simplicity have? Well, with regards to Simplicity Living, of course, if the property market goes down, we get these things revalued regularly, so they go down as well. But of course, remember also there's that rental income that's coming in every week as well, and that helps, that makes sure that there is income arriving at the same time. It's not often, Shamubeel, you're the economist here, right? It's not often when you get economic downturn, if you think about real estate and prime residential real estate as an asset class, is it typically less volatile? So are you a little bit more protected on the downside?
Look, I mean, it's very closely correlated with financial markets. So the reality is that if you look over a long period of time, the returns from financial markets, from equity markets and property is much the same. It's just that the cycles are very similar because the drivers are very similar. I think the difference with our fund in the Simplicity Living is that we have the benefit of the development margins, which we're making even through the downturn. So we're a little bit protected from the cycle because those development margins do come through.
There's a really interesting sort of factoid about this too, is that if we were investing this in build-to-rent housing or residential housing offshore, we wouldn't be generating a single job. But the Simplicity Living crew were telling me the other day, they think that we're now employing directly or indirectly about 2,000 people across these building sites. And so, of course, that's great for the economy. And it's a sort of example of what you see in Australia, isn't it, where you've got these pension funds that have been investing through the cycle, and it helps smooth out economic volatility. This is where KiwiSaver can be a real boon for the long-term health of New Zealand's economy, and you get more productivity with the money coming in too, don't you?
Absolutely. I think it's about having those different allocations and different strategies and giving our members the choices to be able to invest in the things they want to be invested in. Did you have some more questions that were
There's a
sent
question
earlier?
here from Tony about would we consider a rent to own option? And the answer is yeah, we would consider it, Tony. We are giving it some thought. It'll be a while off yet because you've got to have an awful lot of houses built, before you start thinking about diversifying. But it kind of makes sense. It sort of naturally appeals to me personally. This is not necessarily policy, but it'd be kind of nice, I think, to go to first home buyers or retired couple and say, would you like to buy this if you've been renting it for a while? We'll sell it to you at an independent valuation. If you're a first home buyer, we'll provide you with a first home mortgage because we don't lend on apartments, but we built these, so we know we can rely on them. And then you pay that off, and then at the end you sell it back to us at an independent valuation, so that we make sure that the people who are living next to you in the community is preserved by choosing who owns them, and it also gives the person who's selling instant liquidity, like they can sell their house straight away and go and buy their second house. And I like the idea of somebody buying a house where no real estate agents and no banks were involved. So they've saved money all the way along there. But that's something we're looking at.
Still in the future.
Yeah.
So on that, Sam, there was a question here about returns. What returns do you expect from Simplicity Living?
Well, so we do an internal forecast on what we call the internal rate of return. Now, that we are not predicting this. This is not something that you can rely on or that you should base any investment decisions upon whatsoever. This is just internal modelling to show what our expectation would be from our current developments. So this is unlikely to be the actual because there will be more developments and circumstances will change. But we project internal returns of sort of north of 10% on what we call an IRR, internal rate of return, over 7 years. Actually, they're actually meaningfully higher than 10%, but I want to give you a very conservative number because I don't want any investment decisions based on this. But just to let you know, we would not be building a single apartment if this was not a good investment. It has to be and it is members' money. It has to be a good investment on a risk-adjusted basis for them before we went ahead. We did all of this before we started Simplicity Living. So, and the other thing I can say is that now we're a few years in, it's been panning out exactly as we expected. So far our forecasting tools have been good, and we see no reason why they wouldn't carry on that way. The other thing I'd say about it too is when we do that, we don't assume any increase in real house prices. So we just assume that house prices over the long term will go up with inflation. That's really important because you can fluff up these numbers if you assume that house prices will continue going up in real terms, but we don't.
Yeah, and Sam, I guess the two sources of returns for us are coming from the development margins because of the excellent work that Shane and Anna's team have been doing in terms of much lower cost of doing construction than others. And then once tenanted, of course, we get the rental returns, and we've got virtually zero vacancy in our portfolio. And so both of those things are really helping us to be able to provide that certainty of income.
There's a question from Joe here too. Inflation index bonds may help preserve purchasing power in stagflationary environments, but are hard to obtain in New Zealand for small investors. Is Simplicity can we do a bond fund for us to access inflation index bonds? And Joe talks about the New Zealand Treasury, which seems to offer them for high rollers and big investors, but not for small investors. So the amount of inflation index bonds is actually pretty limited in New Zealand, isn't it?
Yes.
Yeah.
It's mainly because while in the US they have what they call the TIPS market, which is very large and very liquid. In comparison, in New Zealand, we don't really have a lot of that. So it's quite difficult to create a New Zealand bond fund that's entirely inflation indexed. But the reality is that most people should be able to replicate the same benefits by having a mix of a bond allocation and a little bit of equity allocation. So I really suggest having a conversation with a financial advisor to construct your portfolio in such a way that gives you both the certainty of income, but also the protection of inflation.
That's cool.
So if you have any questions, please pop them in the Q&A or at the bottom of the YouTube if you're on YouTube. There's a question here about inflation. Did you have any other questions on the email from?
No, that's all good. I've done mine.
And why did inflation not go up much in Australia around 2022? Partly because they had slightly more economic disruption through the COVID period, but also there were some government supports that were reducing some of the reported inflation. So particularly around, I think, from education subsidies and a few other things that kind of reduce their headline inflation rate. But the underlying story of inflation, if you think back to that chart that I showed you, was very synchronized increase in inflation around the world. And that was to do initially, that was very global in nature in terms of those global supply chain shocks, but also that synchronized kind of easing of monetary and fiscal policy. There was just free money everywhere in the economy. So both of those things kind of created that increase in inflation, and those disruptions faded, the interest rates rose, governments pulled back on spending, and it all came down together.
So can I ask you a simple question?
Go on.
Why has Australia done so much better than New Zealand? Like, what are the things that make them rock and roll at the moment and us not?
Yeah, I think a big part of it is their monetary and fiscal policy just hasn't been as boom bust as ours. So they've had a cycle just like us, but it's less in amplitude. They didn't raise interest rates as much,
Right.
and they've been much slower to, in fact, cut interest rates. And the government didn't do the massive amounts of stimulus, and then nothing. So you kind of have this jitterbuzz that we had experienced in New Zealand, but it was much more.
So when I was a kid, Australia and New Zealand, we sort of used to consider ourselves about the same in terms of wealth and it's just gapped up again. Like, what has caused this long-term, gap in wealth? Why are Sydney and Melbourne so much richer than Auckland, for example?
Good question. Do you remember under John Key's government, they had catching up with Australia?
Yeah.
That strategy, which was actually due this year. So we haven't quite managed it. And so we shouldn't laugh because it's kind of sad. But part of the reason is that pretty much from the 1970s, 1980s onwards, the two countries have really diverged in terms of GDP per capita and in terms of productivity. A lot of that has been to do with Australia's had huge amounts of more productivity growth than we have, partly because of economy of scale. Their economy is bigger, they're more connected to the global economies, more diversified. But also, I think they've generally pursued just slightly better economic policies than we have. New Zealand's kind of almost a cartoon version of how public policy is done. We're very purist, we're not pragmatic. And as a result, I think what we thought was, if we just get the public policy right, everything will work well. Rather than going, we also need to support people and communities for those changes to be bedded in well.
And they saved a lot more money, right?
And of course, our favorite topic, Sam, is when it comes to the savings patterns of Australia versus New Zealand, the big divergence takes place, particularly from the 90s. Because of their compulsory super, they've just saved massively. Their financial markets, their savings pool is massive. Their national savings rate is higher. And as a result, they've just had more opportunity to invest in their own economy and in themselves. That's made them richer.
I parrot my grandfather who said, it's not where the money comes from, it's what you do with it that matters. And if you think about, the Aussies make all this money from coal and oil, but we make it from milk too, right? The money comes in the door. It's what you do with it once it's arrived.
It also has to be reinvested, and I think we have been not as good in it as we should be. So I was giving a webinar yesterday on infrastructure. I think when you compare New Zealand versus Australia in our infrastructure pipeline, what's really fascinating is that we both have a pipeline that's actually reasonably big, but theirs is funded for longer. So not only have they announced the projects, they have funded it and they've made it real. So it's entirely likely that we have much more productivity in the infrastructure space, for example, in Australia, because they know that there's going to be work in 5 years' time.
So just a follow-on question then, you talked about government being, I always use the phrase government's the biggest game in town, right? The biggest business in town. If it's that big, and what percentage of GDP is government?
So if you look at our operating spend and capital spend together, is close to 40% of GDP.
Okay. So 40% of our economic activity is in one, let's call it business, government. If that business is in, cost-cutting mode, can the economy ever really recover strongly?
It can, but it's a handbrake. It's kind of, you're doing it with only one arm, right? Yeah. It's kind of like, so it's a real mixing up my metaphors, but essentially what we want during economic downturns is not only do you have monetary policy, interest rates helping you, you also want fiscal policy to be spending more in particular areas to supercharge the recovery. Generally speaking, we tend to see this in infrastructure. Unfortunately, we've seen a pullback in infrastructure spending, but we've got a pretty good indication that infrastructure spending will be picking up over the course of the coming months. So it's long overdue, but when that comes, I think it'll give us a really big help. Now, Sam, we have a very important question about fees.
Oh, yeah.
It says, I was excited at first about simplicity fees being reduced from 0.25% to 0.24%. But when I checked out the numbers, see example below, $100,000 it saves you, $10 a year.
Yeah.
It doesn't seem much. Can we make it better?
Yeah. So it's a good question, because it's like it's 1/100th of 1%, right? But here's how to think about it. Imagine if you were running a business and you said, okay, we're just going to cut our revenue by 4%, because effectively that's what we're doing. Or it's not quite 4%, because we have some fees which charge 10 basis points if you have it lowered. But the revenue cut is much bigger than you think. And so that's passing on the economies of scale. So at our fees at the moment, which are already so low relative to the market, right? In many funds, they're a third to a quarter of what the market does. Our fee cuts now are going to be small because there's a cost of running the business which can't change. There's fixed costs and variable costs. And of course, we are running this now so that we're not trying to make a profit, a cash surplus. And so we will pass on these benefits in small amounts incrementally as we scale. So over time, that will be better. So I think, to be a little fairer, I get your point and I totally understand it, but I think to be a little fairer, look at the fee gap between what we're charging now and what the average fee for the industry is, bearing in mind that we're substantially doing the same sort of business as they are, right? We're keeping these KiwiSaver funds open.
I think the other thing is some of our single sector funds, for example, the global bond funds, global equity funds, they have much lower rates.
Yeah,
so if you do have additional savings that you're making in managed funds rather than in KiwiSaver, you do have the opportunity to access those lower fees.
And I think our sort of moral obligation now is lots of small fee cuts as the economies of scale come through, so you get them faster rather than saving up, building up this huge cash pile and making a big splash, but less frequently. So we'll carry on doing that. There's a question here about the simplicity there as well. Where can I find actual real returns from your property part of the business, the rent build stuff on your mortgages and your mortgages? I can't find it on your website or on my account. No, we don't have that there because that's a special asset class. Those are special asset classes, and we don't publish at the moment those returns. There's a couple of reasons. First of all is they give a false impression in the sense that with Simplicity Living, we have some startup costs at the beginning, which would mean that the returns would look lower than they will long term. And so we think that gives a false impression, and we're not into that. The other one with the mortgages too. The mortgages is pretty simple because it's a floating rate mortgage book. So you look at our current floating rate and you say, okay, this is basically what the entire mortgage book is earning us. And so that's the revenue. Obviously, we have costs in the mortgage fund. They're fairly small, but you can look at our current mortgage rate and that is very close approximation of what it's currently earning you. Of course, it can go up and down. Our mortgages have been as low as sub 2% and as high as over 5%. So we'll have a look and a think about whether or not we would do that. If we had wholesale funds dedicated to Simplicity Living, we would absolutely be providing those returns. So we'll have a look at it. But suffice it to say, we are very comfortable with what they're doing. Both of the investment theses that we went into this with is playing out nicely. From Anthony, would it be possible to allow KiwiSavers to lock in gains by having part of their fund move to a conservative fund while new contributions are into the growth funds? Yeah, but we had a look at this. It's called fund splitting, and we know that we're one of the few KiwiSaver providers that doesn't do this. The reason we don't do it is because it's of complexity. It sounds simple, but it's actually very complexity. And when you're charging 3 or 4 times the fees, maybe you can afford it. But from our point of view, we didn't think that it was in the members' best interest to be providing that function for a few people when it would cost everybody in terms of having to change our systems. Now, we got a little bit unpopular with 1 or 2 media commentators on that too, because we said we wanted to do it. But then when we were, when was sort of top of the pile, we had to look at a proper cost benefit and we just decided this is not worth it. This is not actually in the best interest of members. So I'm sorry, Anthony, that's not something we will be providing. Bear in mind, of course, though, that you can always switch the whole amount and you can go into a balanced fund, for example, if you wanted to. From an anonymous, would you be looking at offering your single sector funds as KiwiSaver options so you can get 100% shares if we want? And how about a mix and match ability like Kernel Invest Now and Smart Shares do? Well, to be honest with you, so the answer is no, we won't. We'll continue to have diversified funds because that's what the vast majority of people want. But those people who want to have that choice already have Kernel Invest Now and Smart Shares. And to be honest with you, I wonder whether or not having a fifth competitor in that area really is worthwhile. That would bring in a whole lot of complexity from our business, a whole lot of cost, which means fees for all members would probably go up, or at least not go down as fast as we would like if we offered that. So I consider that to be, there's a paradox of choice idea. You can provide too much choice. At the moment, if you really wanted to do that, you have other providers. But at the moment, we'll carry on doing what we're doing because, we firmly believe the most important thing here is to have a very diversified portfolios for the vast majority of people. You have a choice of them and at the lowest possible fee.
Yeah. And Sam, I guess personally, the way I invest is I contribute the minimum amount into my KiwiSaver, and any additional savings I put into those single sector funds that I'm interested in.
Okay.
So
that
way I get the exposures that I want outside of KiwiSaver.
Okay.
And so that's just a way for you to essentially create your own portfolio allocation. So there are absolute opportunities to do that in some other ways within our table as well.
From Brendan, would you love to hear the grand plans of simplicity? Would you get into savings accounts, insurance, open up home loans to all? Brendan, I'll tell you what, mate, why don't you just give me a call and we'll have a side chat here, because if you talk about grand plans, I'm going to be like crapping on here for 30 minutes. So look, the answer is where we think people are getting an unfair deal, or where we think there is a better way for money to be invested for the benefit of all New Zealanders, obviously first and foremost members in terms of returns, we'll get involved, and where we don't, we won't. So watch this space. We're always cooking up stuff.
Yeah. I mean, we've been having conversations, Sam, about insurance and savings accounts for a little while. There's quite a lot of complexity in this stuff because these are regulated products and there are some issues. Yeah, but also there are some gaps in the market. So thank you for the question.
And we're having a serious look at infrastructure investing right now as well. Yeah,
absolutely.
From Brendan again, do you think the government will open up KiwiBank to KiwiSaver providers like yourselves? If so, when? Who knows? I mean, there's all the noises that the government are making about it. And obviously, we have been asked along with other KiwiSaver providers to provide feedback. But we are as in the dark as you are as to when and where and how that would happen. And so, I guess just like any other investment, Brendan, we judge it on its merits when it came through. But you can waste a lot of time speculating on these things. I think you just wait and see what the reality is.
Yeah, I think you can be assured that if and when the opportunity comes up, we'll look at it with fiduciary duties in mind, make sure that it's the right decision for our members, not just because it feels like it's the right thing to do. Yeah. All right, so we have a question from Alistair.
Oh, just a comment, really, I think, yeah. Friendly Geordies did a good video on why Aussie and New Zealand went apart in the 80s a couple of months back. Hawke and Keating set up Australia for success. Did they ever? When they set up superannuation in Australia, they're probably making the smartest long-term decision of any politician ever in Aussie history, yeah?
But it wasn't just the saving side of things.
No,
what they had done in terms of still protecting, I know this is probably unpopular in some circles, but they still had a relatively protected labour market. There's invested a huge amount in education. They had, like us, quite a lot of population growth through immigration. So all of these things kind of contributed to that growth in Australia. They also had the benefit of the mining boom. Don't forget that extraordinary mining boom that took place. We had a similar thing, but not to the same extent. So absolutely. We'll definitely go look it up, Alistair. Thank you for that.
All right, I think that's it. That's the end of questions. So once again, apologies for arriving a few minutes late. It's great to have Shamubeel holding the fort here and leading the charge. Thank you very much. And as always, if you have any questions or whatever, feel free to get in touch at info@simplicity.kiwi or just give me a bell, sam.stubbs@simplicity.kiwi. I'm going to leave Shamubeel alone. You've got a real job to do, mate. So thanks very much, folks. See you later.
Thanks, everyone. Have a great day.